Help us answer that question. Is it going to require a vaccine? Do we have to get that far before people really feel comfortable going back to work, back to stores, back to restaurants and bars? Or can we have enough testing and contact tracing to really do the trick?
Well, if you judge from what happened on the market this week, the investors currently think it's going to have to be a vaccine because as soon as we had that news from Moderna, basically shares shot up dramatically and everyone thought, yes, there is an end in sight. But the reality, as all the medical experts keep stressing, is a vaccine's probably a year away. Maybe less if we're very lucky, but not a lot less. So I suspect that the key focus in the coming weeks is going to be on testing, because that's really the essential element that's going to decide whether people feel confident enough. We're dealing right now with a problem not just economics or medical science, but also psychology and how people feel. And in many ways, the most interesting example to date has been Georgia, because Georgia reopened a long way ahead of the rest of America. And the reality is that the economy has not bounced back, nor has consumer spending. And in fact, Politico has just done some research suggesting that, amazingly, about 40% of the workforce has been filing for unemployment insurance. So, it's going to take a long time to get back, unfortunately.
And when it comes to the question of testing and the contact tracing and things, a lot of people put a lot of faith in apps, in technology. You wrote in the Financial Times this week saying apps are nice, they're helpful, but it's not enough. You need some shoe leather involved, such as being done in Massachusetts.
Well, it's very interesting because we spent the last few years obsessed with AI and big data and assuming that they could solve every problem under the sun, but also being pretty terrified of this. And just stop to think for a moment, how much talk have you heard about AI in the last few weeks? I mean, even big data to a degree is not exactly having its moment in the sun, because the reality is that yes, you can use these amazing smartphone apps, and yes, you can use all these banks of data. But if you're trying to reach people effectively with a calming message, which is going to be so critical for getting confidence back and getting consumer spending back, if you're wanting to gather the kind of qualitative data you need to actually have to track a pandemic, you need to combine both social science and big data, computer science. There are some people who are doing that. Paul Farmer, who is regarded as something of a hero in the medical world because he's done a lot of work in emerging market countries like Haiti, has basically been used or asked by the governor of Massachusetts to come into his state and essentially take the same lessons he's used in emerging markets into America to try and combine the human contact, social science, and big data, data science. You're seeing that in other places like Ohio, and it's increasingly being rolled out. But it's interesting for anyone who thinks the future is going to be all tech, because right now that's just not the case, or not if we want to move forward effectively.
Well, when you talk about moments in the sun, certainly Chairman Jay Powell of the Fed had his moment in the sun this week, along with Steve Mnuchin, the Treasury Secretary, as they testified on Capitol Hill. There was a lot of testimony about all the things that have been done, both fiscally and monetarily, to support the economy. But one thing that did not get a lot of attention were some of the swap lines. That's something you also wrote about this week in the Financial Times. And you think maybe historically, when history's written, that may be a bigger deal.
Yeah, I think it's an issue that investors should be focusing on a lot more because everyone's tracking, understandably, what Mnuchin and Powell are doing in the US economy. But what the Fed has done in the last 6-8 weeks in relation to the offshore dollar market, these are entities around the world that have either borrowed in dollars or lent in dollars and don't have access to the Fed directly. What it's done for that is absolutely fascinating. There's quite a regime change going on. And the issue is this. Until 2008, the Fed basically wasn't doing anything to support those offshore dollar markets. Then we had the Lehman Brothers crisis, and the Fed stepped in and created swaps lines with other central banks, which basically turned other central banks in places like Switzerland and the UK and Canada into branches of the Fed to dispense dollars to the other non-American entities that needed them to survive the crisis. 2008 finishes, we then think, okay, what's going to happen next? Was that just an emergency short-term measure? And there's remarkably little debate about what actually is the future of these dollar swaps lines. What we found out in the middle of March, when the markets began to gyrate crazily, was that the Fed is not just as committed as it was in 2008, but it's actually been doubling down dramatically in this respect. And it's not just reactivated the dollar swaps lines, or rather, they've always been there. It's actually got them going again. It's expanded the group from 5 central banks to 14 central banks, and it's created a repo function. And to date, according to the material I've seen, about $500 billion has been sent out essentially through these swap lines to jurisdictions around the world. The biggest single user has been Japan by quite a long shot, because Japanese banks and life insurance companies have built up massive exposures to US credit and other dollar-based instruments in recent years, very quietly. Most people don't know, they haven't noticed. And the key thing to understand about this is that the Fed's actions have not just reduced the stress dramatically in global markets. It's essentially signaled to every single investor around the world, if you are operating in an offshore dollar market, don't worry, the Fed's now got a new safety net which is going to be there to support you. It's incredibly important. And as I say, I find it stunning there's been less discussion about it, because actually this has big implications about where the dollar-based financial system is going to be going after COVID-19.
Well, and this, I'm sure, is not necessarily why the Fed did it, but it may have big implications in the rivalry between the United States and China, because China has wanted to actually reduce the importance of the dollar globally. This may fight against that.
I think the key reason why the Fed's done it is actually not as an act of charity, and not even necessarily as some kind of great nationalist, let's push the dollar on everybody in the world. It's really because the Fed's realized, and the Treasury as well, that what happens in these offshore dollar markets, which are huge, we ignore them day in, day out, but they are huge. What happens in the offshore dollar markets has a huge implication for what happens on the onshore dollar markets and the Treasuries markets. So in a sense, it's an act of self-defense to be doing this, or self-interest, if you like. But it does have a big implication going forward, because if investors around the world dealing in dollar assets now think they don't need to panic if there's a crisis because their local central bank can still get access to dollars,
Right.
like a branch of the Fed, they'll keep using dollars,
Right.
and that will help the dollar's status
Right.
as a global currency, which comes just as China and
Fascinating.
Russia are trying to
Right.
undermine that.